Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
Wednesday, halfway through the trading week. Welcome to Modern Investing Techniques, episode 65. I'm Patrick in Vancouver. Today is June 3rd, 2026. Midweek, let's reassess this week's positions and look for fresh setups. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Canadian investors holding energy names face renewed pressure as oil climbs toward $100 amid fresh tariff and supply disruption risks. Markets opened softer today with the S&P 500 at 7,575, down 0.5%. The NASDAQ Composite sits at 26,939, down 0.6%. The TSX Composite is at 35,062, down 0.3%. Sentiment stays cautious near record highs as higher oil prices, tariff uncertainty, and AI spending keep investors on edge. The portfolio cumulative return stands at $416.37 across 29 trades, with a 62% win rate. Alpha versus the NASDAQ shows a positive 1.53% on the most recent trade window. Share repurchase expansions create a direct capital return mechanism that can support share prices even when broader markets stall. Shopify announced a $3 billion increase to its existing buyback program. This approach works in a high-growth software name trading at elevated multiples. Investors screen for companies announcing or accelerating repurchases by monitoring TSX and SEC filings through platforms like TMX Money or Edgar. They then cross-reference free cash flow coverage ratios above 1.5 times to confirm sustainability. This tactic has historically performed best in sideways or mildly declining markets, where organic growth slows but cash generation remains strong. The main risk is that management overpays for shares or diverts capital from higher return projects. A practical step is to add a custom alert in your brokerage screener for share repurchase authorization increases greater than 5% of market cap. Pair that alert with a 50-day moving average filter to avoid catching falling knives. Imagine you bought an oil services ETF yesterday morning when the latest Hormuz headlines hit. Your market order filled at the ask, but the quoted spread had already widened from 3 cents to 18 cents within the first 20 minutes of trading. That extra 15-cent gap represents immediate slippage that compounds on larger position sizes and is rarely visible in end-of-day charts. Market makers widen spreads to protect against adverse selection when news flow spikes volume without balanced two-way interest. Limit orders placed just inside the widened spread often get ignored until the next lull. Professionals pre-stage orders during lower volatility periods or use midpoint peg orders when available. The biggest mistake is assuming your broker's best execution guarantee protects you from temporary widening. Always check the Level 2 book and recent trade prints for the prior 15 minutes before entering size on any name showing headline-driven volume. This is a simulated trade for educational purposes only. No new position was initiated today. Macy's raised annual forecasts on strong Bloomingdale's luxury demand, while Inditex posted 11.5% currency-adjusted sales growth. Neither name shows sustained volume above the 20-day average to justify entry. Both stocks sit above their 50-day moving averages on daily charts, but lack the volume spike required by current rules. RSI readings remain neutral in the 45 to 55 range with no oversold bounce signal. Entering without volume confirmation risks the same quick fade observed in recent partnership trades. Maximum acceptable loss on any future position would be capped at 6% via a stop below the 20-day average. Skipping a trade when catalysts appear without volume confirmation demonstrates the discipline of waiting for alignment across multiple factors. This approach preserves capital for higher probability entries later in the week. Yesterday's flash trade was SNO on a momentum entry tied to a raised revenue forecast, plus major AWS partnership. The simulated entry came at $237 at market open. The exit came at $239.20 at market close. The position gained 0.93% for a $9.28 profit on a $1,000 simulated stake. The trade gained 0.93%, while the NASDAQ fell 0.6% over the same one-day window. That delivered positive 1.53% alpha. The modest gain validated pairing a revenue beat with a partnership catalyst. Yet the size of the move again showed how quickly momentum stalls without follow-through volume. The rule is to always require volume confirmation above the 20-day average before entering momentum trades on earnings beats. Wealthsimple's options chain now displays real-time implied volatility percentiles alongside bid-ask spreads for Canadian-listed underlyings. This allows TFSA investors to compare premium yields across covered call candidates in under 2 minutes. The edge comes from spotting when IV ranks above the 70th percentile on names you already own. Interactive Broker's scanner lets users filter TSX and NYSE names by free cash flow yield above 4%, combined with recent share repurchase announcements. This surfaces buyback candidates that align with the capital return strategy. It removes manual filing checks and surfaces names with sustainable payout capacity. Macy's posted its first quarterly sales growth in nearly 4 years and lifted full-year guidance on strength at Bloomingdale's. Add M to the TFSA watch list for a potential pullback entry below the 50-day moving average. Inditex reported 11.5% currency-adjusted sales growth in May. Review European retail exposure via the XEU ETF and consider trimming if the euro weakens below 1.08 US dollars. Redfin data shows frustrated sellers delisting properties faster as bidding wars fade. Hold CAD cash with no rotation signal yet into Canadian REITs or homebuilder names. GTA resale sales rose year over year while new listings declined. Avoid adding Canadian REIT exposure this week until inventory data confirms a sustained trend. The portfolio now sits at $416.37 cumulative profit across 29 simulated trades. The win rate holds at 62% with 18 wins. Average return per trade stands at 1.44%. The best trade reached 20.11%, while the worst sat at negative 11.35%. Current streak is 2 wins. Our AI analysis continues learning from the pattern of needing volume confirmation before momentum entries. Open your brokerage platform and pull up the options chain for any consumer discretionary name you already own. Note the 30-day at the money call premium. Annualize that yield and compare it to the stock's dividend yield to see the extra income available from a covered call overlay this week. Tomorrow, I will scan for any volume confirmed setups that emerge from today's consumer retail beats. That's it for today's modern investing techniques. The resources page has links to everything we discussed. Subscribe and share with someone who wants to go beyond index funds. See you tomorrow, and before you go, this show is part of the NARA Network, a family of daily podcasts covering tech, science, markets, and more. If you enjoyed today's episode, give OmniView a listen, a balanced daily world news briefing that takes every side seriously. You can explore the whole lineup at neuranetwork.com. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking